often your guests, Shiv, talk about they have some really good strategies about winning deals, right? Because they're usually sitting alongside 3, 4, 5 other firms looking to acquire a business. In our world, we're very explicitly trying to avoid that and saying, hey, what are some areas that are truly alternative today where we're not competing with a lot of institutional capital and where we can go and kind of take our time underwriting and where we can quote unquote do a deal without have to win it on valuation or one of those typical metrics.
Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Gus Araya of Cordillera Investment Partners. And what I really enjoyed about this conversation with Gus is that we often meet private equity firms that are investing in very similar types of businesses. And what really distinguishes Gus and his firm is that they look at alternative assets to invest in all kinds of industries and verticals that are offline, in agriculture. They invested in a marina, they invest in spirits companies. And so it's very different in terms of asset classes that they look at. And Gus sheds light into their process for finding these investments, how they get deal flow, how they diligence these investments, and also how they create enterprise value inside all kinds of different companies, which is quite different from a lot of the PE investors that have been on the show. And one of the things that I feel is that technology companies and software companies and lately AI companies have been getting so much capital from investors. Meanwhile, you have this long tail of solid businesses that are high growth or high revenue or high EBITDA or margin businesses that don't get that level of attention, even though they're solid business models to be invested in. And one of the reasons is that it's how PE firms have positioned themselves to LPs and how they raise capital, and they're almost kind of handcuffed to the thesis that they're kind of operating within. And meanwhile, there's all these assets out there for the taking, but people are kind of competing for a limited set of assets that all the other PE firms are also trying to land. So I found Gus's perspective to be quite refreshing, and I think the private equity industry in general needs to be thinking about some of these creative avenues to deploy capital as a way to generate alpha for their LPs and investors. So I hope you learned from it as much as I did, and I'll leave you to it. Enjoy the episode. All right, Gus, welcome to the show. How's it going?
Very well, Shiv. Thanks for having me on.
Yeah, excited to have you. So why don't we start with your background and your firm, and then let's take it from there.
Sounds great. Well, I actually started out by studying mechanical engineering, and as I was getting that degree, I ended up working in the IT department of an institutional brokerage firm, and just through serendipity ended up pivoting out of the IT department into working for some of the research analysts and building financial models for some public companies based in Latin America. And I fell in love with modeling businesses. This is back in the day when we were using Lotus 1-2-3. And it's where I caught the bug and realized, hey, I actually want to be an investor, not an engineer. I then spent a few years at Horsley Bridge Partners, both in San Francisco and in London. And that's where I got my first exposure to private equity and venture capital. This were in the kind of booming days in the late 90s, where here in the Silicon Valley, there was a lot going on as part of the dot-com bubble, if you will. But I learned a lot about innovation. I learned a lot about how investors and owners and private companies look to add value. And that's probably where I first realized the idea that, hey, that's what I actually want to do when I grow up. I then spent a couple of years getting my MBA, and then with the advice of one of my mentors, actually spent a few years inside an operating business, a software company where I was a product manager. And that was a really interesting experience in terms of getting to work with a real product, thinking about marketing, about a P&L, working with different types of people throughout a larger organization, and something that has really been useful kind of through the rest of my career as I've gotten more involved in working with portfolio companies. I then was really lucky to be able to kind of pivot back to investing, and I joined the Hewlett Foundation here on Sand Hill Road. Got to work with some amazing people, and there got to continue investing in private equity, and also learn quite a bit about some other asset classes, including real estate and natural resources. And had the good fortune to work for the late Laurie Hoagland and learn about asset allocation, which is this idea of how do you take these different asset classes, these different types of investments, and put them together to create a portfolio that has a good kind of risk and return and diversification profile. After a few years there, I joined McKenna Capital in 2006. It was a spin out from the Stanford University Endowment, also investing in the endowment style. Very fortunate to work with a lot of great people there. And again, kind of continue my focus both on private equity as well as natural resources. And most importantly, that's where I met Ashley Marks and Chris Heller, my two co-founders. And in 2014, after working together for 8-9 years, the three of us decided to spin out and start Cordillera. And the idea behind Cordillera is actually really straightforward, which is just that we believe alternative investments can play a really important role in helping improve kind of the risk and return profile of alternative investment portfolios. Our kind of differentiated view was really around the idea that a lot of these asset classes that, Shiv, we grew up calling quote unquote alternative aren't really that alternative anymore. They've attracted a lot more capital. They're bigger, they're more efficient. Their return streams are more correlated. So for example, today, private equity as an asset class is a multi-trillion-dollar global asset class with thousands of managers, very smart people working hard, very sophisticated, which just makes the whole asset class more competitive. It doesn't make it a bad asset class, but just simply it's not quote unquote quite as alternative as it used to be. And so our view is, hey, why don't we focus on just finding these areas that are, we call them niche, less correlated, where we can get two main benefits. One is around the idea that if we spend our time in fishing ponds that are less overcrowded with institutional capital, we have a better chance at generating more return per unit of risk. We're not competing with a lot of people. Often your guests, Shiv, talk about they have some really good strategies about winning deals, right? Because they're usually sitting alongside 3, 4, 5 other firms looking to acquire a business. In our world, we're very explicitly trying to avoid that and saying, hey, what are some areas that are truly alternative today where we're not competing with a lot of institutional capital and where we can go and kind of take our time underwriting and where we can quote unquote do a deal without have to win it on valuation or one of those typical metrics.
Expand on that a little bit more, because just to bring it live for the audience, what are some of these alternative asset classes or types of businesses that you're deploying capital into?
Sure. Why don't we go back a little bit in history? Because frankly, Shiv, they change over time. So when we got started back in 2014, one of the earliest areas we got involved in was music royalties. This is where you can own songs or catalogs of songs that have been around for a long time and generate some very steady eddy cash flows. And if you go back to 2015, the music industry was out of favor. People were not really looking at that industry. Yet we were able to see that you had these cash flows that were very steady, that you could buy at fairly attractive multiples, and that also were pretty uncorrelated, meaning if you thought about what drove the return stream of some of those copyrights or catalogs, they didn't change a lot year to year and certainly didn't have much to do with what's happening with interest rates or with the S&P 500. So for example, we were fortunate to partner with some great operators and start buying those types of assets at what we thought were very attractive multiples. And then fast forward, Shiv, 5-10 years later, it's something that the general market and institutional investors certainly discovered. Today, you have lots of funds and lots of investors that own or are looking to buy those types of assets. what have you seen? You've seen returns compress, and probably some of those assets become more correlated. So what's typical for us is we try to be 3 to 5 years early into finding those opportunities. Once the rest of the world finds them, we step away. Another example is around litigation finance. Here, this is, imagine two companies in a legal dispute. One of those companies may need some capital in order to kind of see that through. And I think for most people, you can kind of intuit that, does company A or B win that lawsuit has nothing to do with, is the S&P 500 going to be up or down that year? So there's kind of a very important diversification, non-correlation element to that strategy. And again, we were fortunate to get involved early on in providing capital for those types of situations. Again, fast forward 5 to 10 years, the rest of the institutional world found it. Today, you have lots of funds that do that. And so we at Cordillera, just kind of step away. We're on this constant treadmill, if you will, to go and find the next thing. And I'll mention one more, Shiv, and then I'll stop, which is our investments in boat marinas. So also 10 years ago, we spent a lot of time looking for kind of fragmented industries. And for a variety of reasons, the institutional world had defined real estate into some very particular buckets. You have office buildings, multifamily, industrial, and hotels. And even though there's over 5,000 boat marinas in the United States, it was just not an area that institutional capital had focused on. And so over 80% of all boat marinas in the US back then were owned by mom and pops, unlike, in office buildings that are mostly owned by institutional investors. And so that meant, it was a really inefficient market. And so we were able to find a great operator within a company structure, go and acquire these assets and, put them together into a growing business in an area that was not competitive and also fairly diversifying. If you think about the marina business, unlike other areas of real estate, you don't get the boom and bust cycles through overbuilding. It's very, very difficult to build any new boat marinas. And it's also like a storage business where you're kind of steady Eddie, kind of, if you will, parking boats on water or on land for some period of time. Fast forward again 10 years, and just earlier this year, we had one of the largest private equity firms in the world acquire, the largest boat marina business in the US. And so that now is likely to become, again, a more institutional asset class. So those are hopefully 3 examples that show you kind of how we try to find things ahead of the crowd, find them when they're least competitive, and eventually exit those opportunities when the rest of the world finds them.
Yeah, that's great. Actually, one of the things that I've noticed, and it's kind of an interesting pattern, is that in a lot of ways, PE funds are captive by the way they raise money from their LPs that restricts them from investing in some different types of assets. And I'm seeing obviously more PE firms starting to be more creative because they have capital to deploy. So they're going more into sports, they're going more into music, they're going into different assets because you need to find quality businesses to acquire. But a lot of PE firms are still stuck in, I got to find that software business or a recurring revenue business that has a certain amount of net revenue retention, and they all kind of look and sound the same. And so everybody ends up competing for the same assets. Meanwhile, there's this huge group of businesses in different industries that are profitable. They just have different business models. They have recurring revenue, quote unquote, in different ways, but the underwriting of that is not being done in the same way. And I feel like a lot of opportunities are being missed. So can you talk a little bit about that? And then the second part that I'd love to kind of hear on is, what about selling that into your LPs and helping them understand that you're going after alternative asset classes?
Yeah. Well, look, very much agree with your first point, Shiv. And there is a structural element to this. If we go back to the idea of asset allocation, look, alternative investing has been around now several decades. And so it's become a little bit more codified, what you mean by private equity. And within private equity, there's buyouts and there's growth and there's venture capital. And then within each of those, there is some further segmentation. And so the industry's become a little bit more calcified in that sense. And frankly, it can be easier to raise capital if you fit very neatly into an existing bucket that institutional investors want to put capital into. So that's the easy part. But you're absolutely right that the downside of that can often be that you have a little bit of a straitjacket. You've been hired to invest in something that fits within some very specific parameters. It might be an industry, it might be a stage of a company, it might be a geography, it might be a business model like SaaS or recurring revenue of a certain type. And that like I said has some pros to it, which is you can become a specialist at it, but you are really constrained in moving into other areas that you think have more white space and are less competitive. Also, a lot of consultants that are out there recommending funds, they often think about these asset classes, they think about benchmarks. And again, it's easiest if you can kind of play into those buckets and benchmarks, because then, it's easier for them to kind of talk about you. It's easy for them to recommend you. But the downside, again, is you get in this kind of straitjacket, very calcified investment approach, which may leave you stuck in very crowded areas.
Yeah, and it's harder to generate alpha when everybody's chasing the same deal, and that pushes the valuations up, right? You kind of need to be in places where you don't have as much competition and find assets in places where people aren't looking.
That's certainly our view, and that's what we think the original promise of alternative investing was, right? Go to these areas that today are just not overcrowded with capital, because otherwise it is very competitive. And private equity, you've got very smart people with a lot of capital, with business models that drive a lot of efficiency around finding a certain type of deal. To your second question, Shiv, because I think they're related, which is um, there is it's not easy to go and then convince people around the idea of necessarily, well, we're just going to go and find things that are really different, because things that are different sound scary. You might say, well, I've never heard of this before. You don't know what asset class they belong in. They're not easy to benchmark. So all of the things that kind of push people toward those kind of very specific business models are some of the challenges of kind of taking the approach that we do, which is out there looking for these less crowded, kind of non-institutionalized areas. But the way that we have found most successful to talk to investors about that is, again, remind them about why this makes sense. It is not about looking for something different for the sake of being different. You have to believe that being in a less competitive area is going to help your returns. And if you overlay looking for things that are really diversifying, that kind of have a return stream that zig when everything else sags, that can be very valuable to their portfolio, to increasing their Sharpe ratio. So that is the starting point as to why. And then it's really around the idea that how do you do it? Do you have a repeatable process to go and do this? Because it is a lot harder, Shiv, than it sounds. And so just like any other firm, we have a kind of wash, rinse, and repeat model. Ours just starts in a very different part of the equation. For most of your guests, oftentimes, they source a very typical type of business within a particular industry, and they have a really clear plan about their 100-day and 1 year, etc. For us, our process starts with, how do we go and find these areas that are not overcrowded? And we have to talk to our investors about having a true north. And that true north is still about, we're trying to generate a certain level of return. We think a lot about managing risk and about the downside. We are looking for areas that we believe can be diversifying, that aren't just going to go up and down with everything else in their portfolio, and where we can find great operators. So Shiv, everything that we do, ultimately, whether it's running a boat marina or buying a music asset, we partner with great operators in those businesses or assets or platforms. And so it's being able to kind of explain to investors why we have a repeatable model across all of that, which really has taken us, years to really develop and perfect, is why we ultimately, get people across the line to say, okay, this makes a lot of sense. Last thing I would add there, Shiv, is many of our investors were already trying to do this themselves. They had said, you know what, if we're going to outperform our peer in some way, we need to be a little bit more innovative. We need to be out there finding these things. And maybe they did, and they realized it was really, really hard. You have to do a lot of primary research. Things don't come nicely packaged. You don't have a 10-year track record of institutional investing in these areas. Something that is a lot of work. And so ultimately, why they would come to a Cordillera is basically to say, wow, you guys only spend your time doing that. You have those expertise. You can be our team extension, our eyes and ears into kind of, bringing those deals in house. And also education. A big part of our value add is not just doing the deals, but helping to explain to investors why does it have these interesting characteristics.
Right. Yeah, I understand that. So, but help me understand the value creation side because you touched on that a little bit earlier. Buying, let's say, a piece of a music business is very different than buying a boat marina, which is very different than, let's say, investing in a triathlon league and some of these other assets that you have. And value creation would look very different inside each of these assets.
Yeah.
So, how do you explain that to LPs? And then what does your process look like for creating enterprise value beyond just bringing capital to these types of investments?
Yeah. It's a great question. The starting point for us often is if we're doing our jobs well by being in these more kind of off the beaten path areas, we are often can add value in almost the kind of investing in private equity 101 type way, meaning we're going into industries where we even have to explain how does private capital work? Why is it that we can add value in some of the simplest ways of helping you professionalize part of your team, getting your financials to be transparent and clear, setting KPIs for your business and your sales team, all of the things that in, call it, the more middle of the fairway traditional private equity, it's almost already done by a company. By the time it's been sold 3 or 4 times to a private equity firm, all of that stuff is really, really dialed in. When we're going into some of these new areas, that can be really transformative to a business, just bringing that capital and bringing what we call the Cordillera in a box, helping put all of the key pieces to institutionalize, professionalize an area that had never really seen that type of capital before. Another value add component is helping kind of educate and evangelize. So for many of our businesses, ultimately, if we want to grow them or kind of really create the most amount of value, we want to bring in more capital over time. And we've developed a little bit of the muscle and know-how of how do we go and take an area that most investors haven't heard about. It doesn't really fit a typical asset class. And how do we explain to them, what are the drivers of returns? Why is it uncorrelated? How we can create value and almost like lower the bar for these businesses or assets or platforms to grow by bringing in that institutional capital. And so that can really be value added from our perspective, Shiv, which is to almost help institutionalize some of these areas by bringing in the right operating partners. We also, as you mentioned, don't have a one size fits all approach. Sometimes we're investing just in assets. Sometimes we're investing in a company. Sometimes we're creating a platform. And we have to have different toolkits. We work with different law firms that specialize in one type of structure versus another. We work with different valuation firms. Some might be really good at, let's say, valuing a music asset. That might be a very different valuation firm that helps us do appraisals on boat marinas, for example. We work with different accounting firms. And so really kind of being able to have a full toolkit where we can, to your point, look at each different bespoke investment and say, we're not going to make everything fit into, every square peg fit into this one round hole that we've defined. We actually go and say, we'll bring the right toolkit to add value to that business in whatever way it makes sense.
Yeah. Does that change kind of your own operating model as a firm? Because there's so many different types of businesses, and you might need different resources, different types of operating partners or advisors. Like, how do you manage that on the cost side as a firm? Because I can totally see how, let's say, a PE firm just focused on fintech or health tech can find economies of scale, but for a firm like yours, you almost need different resources for different companies. So how do you structurally manage that?
Yeah, I think it really starts first with the team and the culture at Cordillera. So we do not set ourselves up to have asset classes or specialists where, someone's a hammer looking for a nail, meaning we don't hire someone and say, Shiv, you're hired to be, the whiskey aging expert at Cordillera, and that's what you're going to go do for the rest of your life here. We take a broader approach around working in teams, growth mindset, working together, learning together, so that we can make, first of all, the best decisions. If you're going to compare a music opportunity with a whiskey aging opportunity with a spectrum license investment, first of all, you need a team that can really understand what are the trade-offs that we're making across the whole portfolio, and across these different types of investments. And so that is a very important element of how we have organized ourselves that allows us to really kind of attack, the broadest field as possible, so we can find things that are more off the beaten path. Second is to get that scale or that institutional knowledge. Operators are really important to us, Shiv, and we do get some scale here because in our perfect world, and fortunately this happens often, is we get more than one bite at the apple. So, first we invested in music, and then as that got more crowded, we looked at other areas related to film and video games and ebooks and short form video content, all things that, were kind of the white spaces that remained as music got more crowded. And we were able to work with some of the exact same operators. So we didn't have to go and start from scratch and, find the new accounting firm and find the new valuation firm and find the new operating partner. That is a huge plus to us, and something that we have now, call it 11, 12 years into our business, that frankly was very, very difficult right when we got started. So even though we have a broad set of opportunities, we have, call it an established stable of operating partners that can already be our go-to people in many of the things we do. And that's a huge efficiency advantage. We know who they are. We know how to work together. We're not reinventing the wheel every time. We can kind of reuse certain processes or legal documents, or partners in different ways that allow us to move those deals forward without starting from scratch. But you're right to point out that, if we go into somewhere that's totally a blank field of play for us, it does require a lot of time. That is the bottleneck in our business model, which is we need the time and put in the resources to go and learn and investigate and do the primary research. And that's why we're differentiated. That is the moat around our business. If that were really easy, Shiv, we probably wouldn't exist.
Yeah, I think that right there's a secret sauce in that, because I think that would be hard for other firms to duplicate in terms of being able to buy a lot of these companies and even be competitive with you guys, because it's building that process, having the operators, having the value creation plan, and all the everything else that kind of goes along with that. Uh, Talk about the sourcing side, because again, if you are focused in a specific sector, there is kind of like a rinse and repeat playbook that you can go after companies in that space. But in a model like this, you almost have to be looking in multiple areas and source multiple types of deals and have the capacity to be able to meet that many companies and underwrite deals like that. So walk us through your sourcing approach.
Yeah, this is probably the most important area of focus for us, given our investment strategy. And so there's a few different elements. And frankly, again, we didn't start out with all of this. It took us years to put them together, and we do think it's a competitive advantage today. So one of them is thematic, and it's the one we had day one. So for example, we, back in 2014 thought, hey, there's a lot of interesting things going on with different types of royalties. They seem to be able to meet our return profile, we have a sense that they may be uncorrelated. Let's pick that as a theme and let's go proactively look for some things in that area. And so that's how we found music royalties, back in 2015, and a few other areas that we've invested in that are related to those types of royalties. Another thematic view for us was around environmental markets. Back in 2014 and 15, you started to hear about carbon markets, cap and trade markets, different types of allowances and offsets. And we said, that sounds interesting. Let's go spend time thematically understanding that area and what is that opportunity. And we found several things in environmental markets that we've done over the last decade. So that thematic approach is really important because it allows us to focus our energy proactively into an area that we have some reason to believe is going to be productive. And it starts with Shiv having a true north. So we do know, again, some return profile, some risk profile, some diversification profile that we're aiming for. And that helps us kind of filter those themes. Because look, there's lots of things out there that might be uncorrelated, but they have a really low return. And so we shouldn't be spending a lot of time chasing those things down. That's the beauty of that. The other approach that has been, really beneficial for us, over the last kind of 5+ years is the inbound. So when we got started, no one knew who Cordillera was. In fact, people still can't really pronounce our name. But what's happened now that we've been in the market for a decade, we've done lots of different deals in different areas. People who are out there with a different type of asset, with a different type of strategy, with a different type of business, will find their way to Cordillera. So one example is in the whiskey aging industry. You had a couple of folks that spotted this really interesting opportunity back in 2018, which had to do with kind of a supply-demand imbalance and the slope or the contango of the whiskey aging curve. You can imagine these folks from Kentucky knocking on the door of some institutional investor and saying, hey, I want to talk to you about this really interesting whiskey opportunity. And the first question they get asked is, great, what asset class is it? Should I connect you to the private equity person, the real estate person, the hedge fund person? And they say, I don't know, I'm just here to talk about whiskey. Those folks will eventually find their way to Cordillera. We put a lot of effort into building those networks. And that's really, really valuable because they'll come to us. We've got kind of this open door policy where we say, wow, never heard of that before. That sounds really interesting. And again, we have some filters that say, okay, great, let's dig into that. And that is incredibly valuable for us. Again, it took us a few years to build that pipeline. But, that really means that things can come inside Cordillera that weren't necessarily part of a very explicit theme. The other sourcing channel is really our investors. So again, most of the folks who invest with us, prior to even meeting Cordillera, thought it was a good idea to go and try to find truly alternative investment areas. And so they themselves are looking for these things. They have deal flow that maybe we don't see because of where they're located. Maybe it's a family office that has a deep network in a different industry, et cetera, et cetera. And so they know what Cordillera is looking for, and they send us deals usually that are curated, that they know is something we might be interested in. And so we're just incredibly lucky to have, just a phenomenal group of investors that are like-minded from this perspective, that are looking for these types of deals. And when they find it, they're willing to send it our way. Hopefully we get multiple bites at the apple. And so we work with an operator in a certain industry or a certain type of asset that gets crowded. They might come back to us and say, hey, I know we don't want to do this anymore because now everyone else has found it, but we know this thing that's adjacent to it, but still kind of white space. Let's go after that. And so they bring us a deal. They're like, we've worked with you before. We've done this. We know you. How about we go do kind of the wash, rinse, and repeat, but just in something that's a little bit, off to the side. So those are really kind of the four ways, that we source deals at Cordillera.
Yeah, I think your point on the inbound side is really important. I was talking to another PE firm yesterday, and just this idea that even though PE firms are investing in companies and those companies themselves need help with, let's say, branding, positioning, messaging type of work, a lot of PE firms look and sound the same. But in your case, you've kind of crafted this unique position for yourself for these alternative assets. And so when they look around and they're like, okay, I potentially need some institutional capital here, in a way, a lot of other PE firms don't seem like a fit. And you are one of the few firms that are speaking their language. So you get the inbound volume, whereas those other PE firms are competing with hundreds of other companies or firms that are trying to pass capital on to the same company. So it's almost a positioning exercise as well, which increases your deal flow.
And that's exactly how we try to position ourselves. And again, it takes a while to build that network. What I would say, there is the other side of that, Shiv, as you can imagine, which is you can get a lot of inbound that's not that interesting, right? People may have some idea that's quirky or non-institutional, and there's a really, really good reason why, why probably institutional investors are never going to go down that route, or they might think it's non-correlated, but you peel back the onion and you immediately say, wow, no, this is really correlated. So the corollary to getting that inbound and building that network is building a really good filter, so that, to your point earlier, we don't want to waste a lot of time. We could suffer from inefficiencies. And so getting quickly to things that we recognize, there's really a lot of pattern recognition, so that we can kind of take that open door kind of front of the funnel and quickly get our team to focus on things that ultimately hopefully end up being actionable.
Yeah. Yeah, I think that's fantastic. Just last question, talk about the vetting of these investments, because they're in different types of assets. The books would be different. The assets on the balance sheet will look different. Like, talk about the diligence side of that. How long does it take you to kind of vet these companies and figure out if it's worthwhile for you to be investing your capital here?
Yeah, it takes a while, and that is the benefit and the opportunity of being more off the beaten path. Again, in a more kind of middle of the fairway private equity industry, again, you're competing for deals. The deal's going to close, it's a competitive process. You've got so many days or weeks to get there. When we go and find something new, again, think of a music asset back in 2015 or whiskey aging opportunity in 2018, there's no gun to the head. You're not competing. And so it is really important for us to have time, because if we don't have time, we're probably in the wrong place or more likely to make a mistake. Then there's having some skill set to start that process within Cordillera. And this is, again, where we're fortunate to have kind of a multidisciplinary approach. So if you look at the backgrounds of my partners like Ashley and Chris and Taylor and myself, we all spent decades investing in different types of alternatives. And so that's really useful skill set, Chip, because all of the businesses that we're describing are a little bit different, but they all have something. Boat Marina has a lot to do with real estate. I mean, there's just some element. If you've underwritten a real estate deal before, you can understand quickly some things about that. If you've underwritten some type of asset that is a copyright, you can understand another type of intangible asset. And so what I would say is the starting point has to be that the team that we purposely try to build at Cordillera has some kind of domain expertise that is very broad, that allows us to get started. We combine that with time and then doing a lot of primary research. Guess what? You go visit a lot of boat marinas. You go visit a lot of distilleries. You go visit a lot of music executives. You go talk to a lot of law firms in the case of litigation finance, or professors that teach law back in the day. And so, again, there is kind of this research element, and we call it a growth mindset, which is we don't know everything, but we believe we have the ability to go and learn and then bring in the right operators. So we have, kind of a fairly clear view about to what level can we learn independently to verify some of those true norths that I described around risk and return and diversification. But we get to a point where we say, wow, this looks interesting. Now we need to go a mile deep. And that's where getting the operator is part of that. Meaning we go and say, okay, do we want to partner with these folks in this strategy? And they help us. Together we do it in a true kind of partnership model, go down the rest of the learning curve. And we may have a lot of input into, that's a really good idea, but you're not thinking about the right structure. The best way to optimize this asset is to do it in this other business or do it in this way or that way. So there is very much a research element that we do in partnership with our operators that creates a lot of trust, a lot of learning. It's very collegial. And ultimately, when we are our investment committee are voting on a deal, it's something that is not a rubber stamp. It's something that the whole firm has gone through that kind of learning process together, and we know that operator, and we just get a lot of conviction. But we need time. I think ultimately, Shiv, it can't be something where we have a gun to the head and need a few weeks to make a decision. We need our time to go through that process.
Yeah, I think that's fantastic. I think just kind of holistically, this way that the types of assets you're focused on affects all aspects of running your firm. Right? It affects how you create value, how you actually source the deals, how you diligence the deals, and even your positioning in the marketplace and how you're able to win deals. So I think that's fantastic. As we're coming up on time here, you guys, just if people are listening and they want to get in touch with you, what's the best way that they can get a hold of you?
Yeah, please visit us at cordillera-ip.com. There's a link there for an email. I promise you it is not a black box. That actually goes to the senior members of the Cordillera team, and we'd love to hear about interesting investment ideas and opportunities. So please reach out. And like I said, we've got an open door policy and want to hear what people are doing out there that is interesting and differentiated.
Awesome. Yeah, and we'll be sure to include all of that in the show notes. And Gus, with that said, thanks a lot for coming on and sharing your wisdom. I think the audience will learn a lot from it, and I appreciate you coming on and sharing all of it.
Shiv, thank you for having me. It's been a pleasure.
Likewise. Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.hadasas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.